We know that it's bad. We know that our predictions of being positive at this time last year were terrible.
You know who was more obsessed with Bank of Canada rates going down? It wasn't buyers, it was sellers.
Where are we projected to be?
12 months from now, I'm trying really hard to be optimistic, but there are a lot of headwinds.
Welcome to the Tom Storey Show with Steve Karrasch and Tom Storey, where we discuss everything real estate or whatever else is on our minds.
Welcome back to episode 190 of the Tom Storey Show. We have a four-time repeat guest this week. Brendon Ogmundson has joined the show again. And Brendon, we're making this a bit of a yearly tradition. You're coming on near the end of the year and kind of recapping what the hell just happened and then giving us a bit of an outlook into the next year. For viewers that are maybe newer to the show, Brendon Ogmundson is the chief economist of the BCREA. And welcome back to the show. How are you?
Thanks. Look forward to this now every year. So I'm this year not as fun to talk about. 2025 wasn't awesome, but we can get into it. But always happy to be back.
I'm going to do a quick plug and then we'll get into it. We have a Christmas wish here, Brendon. We're trying to get our subscribers to 8,000 by the end of the year. And Steve, where are we as of recording this? We're like 100 away?
We're exactly 100 away. We're at 7,900 as we speak. So we need 100. Brendon's going to give us 100 subscribes from all of his different Gmails that he has. And we're going to get there by the end of the episode.
Just so many bots going to be subscribing.
Yeah, we don't care who subscribes. Just get subscribed.
You could just buy 100 for like $12.
No. Yeah, please nobody go to Fiverr and buy us subscribers. We want real subscribers. All right, now that that's out of the way, Brendon, 2025, I felt like going into this year, we were optimistic. We felt pretty good end of last year for, I think, not just BC, but Ontario too. Like sales volume was like October, November numbers were pretty good and we were feeling good. And then January happened and February happened and we were still feeling okay. And then March happened. So like, give me your perspective as an economist. What did we just go through? Have we seen something like this before?
Yeah, I mean, so we were super optimistic heading into 2025 because sales were back to, after they'd been really hit by rate hikes. The previous couple of years, we were pretty optimistic that sales were going to be back to kind of normal levels in 2025. And then we got this massive uncertainty shock from the threat of tariffs. Like it's hard to find a precedent for that type. I mean, we've obviously had uncertainty before, and we've had major macroeconomic shocks before. This was pretty different in that it was really just like a looming threat all year with different levels of severity. But when it first started, like when I was going on podcasts or going around speaking to different audiences, it was pretty gloomy. We were running, I think I may have talked about this because I was running like tariff simulations over my Christmas holidays, which was the best way to spend the holidays. I really recommend it. But we were running these simulations that were based on a threat of 25% blanket tariff on all Canadian exports. And that was producing some really scary results for the Canadian economy, and all economists were doing this. So like all the headlines were not like in the spring and the kind of February into the spring were not like, will we have a recession, but how bad is this recession going to be?
Right.
Fortunately, that didn't materialize. It turns out that basically everything we sell to the United States was still covered by our existing free trade agreement and had essentially zero tariffs. So the effective tariff rate instead of being 25% was like 5%. So the impact was really the uncertainty and not as much like a direct economic impact outside of certain sectors. But that was enough to really upend confidence in the economy. If you're constantly reading about whether or not the economy is going to be in a recession, households are going to worry about spending and their jobs. And we saw it really hammer the housing market, especially through the spring and summer.
Because it feels like the housing market's been in a recession for the last 3 years, has it not? Like I get the total economy based on the GDP technically isn't. Housing has to have been in a recession, right? Like what we just went through, the biggest drop in prices we've maybe ever seen.
Well, I think in Ontario, you have, yeah. There's a real difference. So yeah, we've had below normal sales in BC for this will be the third consecutive year, running in like the 70,000 kind of sale pace. 85,000 is like a good normal year. In Steve's market in the Fraser Valley, it's the worst year in 25 years. We couldn't even generate 1,000 sales a month essentially in the Fraser Valley. We're going to have the worst years I think since 1999. Same with Greater Vancouver realtors area as well is going to have its worst year in 25 years. Not every market's like that. Outside of the Lower Mainland, things are getting back to normal in a lot of markets. So we can talk about why there's that difference, but prices have been really resilient. Again, the Fraser Valley a little bit weaker. They had much more of a drop from peak, and they're still, I think, year over year probably down like 5 or 6%, depending on the market and the product type. But Vancouver's down like 2 or 3%. And if you look at like the condo market, I mean, the Toronto condo market's down over 20% from its peak.
From peak.
And Vancouver, from its peak which was actually like in 2024, not 2022, it's down like 3 or 4%. So prices are really resilient. Like prices aren't moving. We talk about 3 years of very slow sales, and this year slow sales in 25 years, and climbing inventory, and we're talking about price drops of like 3 to 5%. It's kind of it's not what you would expect. If you told me prices or sales are going to be their worst in 25 years, I would have expected we were going to have much larger declines in prices.
Why do you think that's been? Why have so many people been able to, in a good way, be stubborn with I'm not selling for less than this with everything that's going on surrounding it and not very many sales happening?
There's just no urgency on the part of sellers because there hasn't been, like, especially for maybe owners in some of these more expensive markets, they're a little bit more insulated from some of the potential economic shocks. If you look at a market like Vancouver, like city of Vancouver and surrounding areas, about 50% of owner households don't have a mortgage, so they're just not as vulnerable to like rise in rates or any kind of payment shock. Like we saw a lot of renewed mortgages this year, maybe cut into some spending, but they're not cutting prices. They don't have to sell, and they're willing to wait instead of massively lowering prices to meet buyers demand.
Steve, what are you seeing with your listings with your clients? Are you finding them more open to today's prices? Because we like me and Steve talk a lot, obviously not on this podcast too. We use slightly different language than when we record on this. And Steve's like, can't get over how many homes are just sitting there not changing their prices in your market. Like we talk about that a lot.
Yeah, there's a lot of them that are sitting there. I find that the listings that I have that stay on the market are the ones where, we know the people aren't realistic, or they're waiting for the spring. That seems to be the thing that happens around this time of year. We're waiting for the spring to see if things will change. And I'm like, they're going to change. But what I'm seeing is continuing change of a downward direction. They're not going to stay where they are right now. But I'm glad to hear, in a way, that this is the worst market in 25 years in the Fraser Valley, because it's been my worst year. So I'm tracking with the market. Yeah, I'm tracking with the market. Why do you think, do you have any ideas of why areas like the Fraser Valley are doing so much poorly now? And particularly, I'm going to say in the last 2 or 3 months are some of the steepest price declines that I've seen.
We tested a whole bunch of, because this is one thing that's been really vexing me, like especially because for a while there was actually even a divergence between Fraser Valley and like Greater Vancouver. So I don't know if everyone knows all of the regions we have in BC, but the Fraser Valley is like a big part of Metro Vancouver, but then we have a Greater Vancouver Realtors board that is not all of Metro Vancouver or Greater Vancouver, so it gets a little confusing. But in like the big parts of Fraser Valley, Surrey and Langley are like also about 25% of Metro Vancouver. We tested a lot of hypotheses, though, about why, for a while there was a divergence between those like city of Vancouver and suburbs, and then Surrey, Langley, Abbotsford. They're now, Vancouver's weakened a bit, but there was for a while, like, why is Surrey doing so poorly when, like, Burnaby isn't, right, at the time, or why in general is the Lower Mainland doing so much more? Why is it so much weaker than like the Okanagan or the island? And so we've tested a bunch of things. Affordability is the one that jumps out the most. Didn't turn out to be that statistically significant, like as a differentiator between regions. We tested presence of a mortgage with affordability. Didn't seem to matter at all. The one thing that correlates really well, but over a really short sample, is the change in net migration, which maybe is like a proxy for like investor demand, perhaps in the Lower Mainland. I think investors have just completely fled the Lower Mainland market, and maybe like, even though most of the decline in net migration over the last few months or a couple quarters is really non-permanent residents who aren't owners, but maybe that decline in migration is a signal about rents and investor appetite to invest. If you're because of federal immigration policy, we're sending a lot of renters out of the country, temporary foreign workers and international students, mainly. That's a signal that the rental market's going to get weaker. There's already a lot of reasons not to want to be an investor in BC, and if investor demand is a big share of sales every year in Metro Vancouver, those investors leave, you're going to have on top of everything else very, very weak sales.
When the big boom happened here in Ontario, like Toronto didn't see the price increases that the outer markets did. Like Durham saw, that York saw. Was that the same over with you guys? Like I'm guessing Fraser Valley went up way more than City of Vancouver, so that's probably why it's experiencing the same thing on the other side. No.
There was we tested that too. So there was a point where I think Fraser Valley's average price or their HPI price was almost equal to the Greater Vancouver area, which it happened really fast. So prices went up, I think in some markets like 60-70%, and it came down sharply once the Bank of Canada started raising rates. So it came down 25% or something from their peak. That didn't happen in Vancouver. Vancouver prices during the pandemic went up about 15-20%, I think. But haven't really given much of that back in the last few years. We did test, that was sort of a hypothesis that maybe markets like the Fraser Valley, Chilliwack's another one, that saw a really large run up in prices during the pandemic, and now perhaps you have a lot of households that are underwater because prices have come down. Tested that hypothesis as well. Didn't explain why sales are so much weaker in the Fraser Valley. So it was a good candidate. I thought it was promising, but unfortunately, just wasn't a big differentiator.
It does appear that investors are not there like they were. That's obvious.
Yeah.
Do you have numbers on like how many investor or what percentage of purchases were investors in 21, 22, 23? Versus say now? Do you get numbers like that?
No, I mean, we have like survey data from the real estate boards. It's not super high quality because the sample size, it's not random, and its sample size is kind of small. But generally, I think investors have had, over a long period of time, have been 15 to 20% of sales in Metro Vancouver. I mean, so enough if that drops out completely, which maybe it has, you're gonna have like a big hit to overall transactions. So I'm guessing that's a big part of it. In the Metro Vancouver market, maybe Toronto was like this as well. Like most investors were in it for the price appreciation and not the cash flow. Like most were cash flow negative. Now, if you're kind of looking 5 years ahead, like the price appreciation probably isn't there. And the cash flow certainly isn't there, and you can invest your money in given where interest rates are, at much less risk and get very similar returns. If price appreciation is going to be close to inflation or below. If you're an investor and all the headaches on top of it, where BC's a very tenant friendly market, and there's a lot of restrictions on what you can do with your investment property here. Pretty challenging to want to be an investor in BC.
Brendon, there's something that I've been struggling with as someone that tries to track the market, and I'm making like weekly or monthly videos trying to update people on the city of Toronto. And I'd love to know from your perspective, to really break this down, there's 3 ways we can track prices, right? We can go median, we can use average, or we can use HPI benchmark price. So
Yeah.
for example, like the condo numbers in Toronto haven't looked that bad when you're looking at average price, but like I know they're down more than the average price because more 2-beds are selling. Like I've pulled that data myself. From your vantage point, is there a best way to track like true market? Is benchmark the best, even though sales are down? Like, what do you think people should be focusing on? Because average price sounds good. It's average, but I feel like it can also be skewed with lower sales volume.
Hey, agents, you know that a clean and crisp real estate website is a must for your business. To start your free site right now, go to realtyninja.com/Tom, and you will pay absolutely nothing until your site is ready to launch. And then when you are ready to launch your brand new site, you will save 20% off your entire first year just by going to realtyninja.com/Tom. So what are you waiting for? Get a beautiful real estate website for your business right now at realtyninja.com/Tom.
Yeah, it's also the average price of the stuff that's sold,
Right.
right? It's not the average price of the stuff that's still sitting, or so, because they're obviously average price would take a hit if some of those, like Steve was saying, some of those owners drop their prices to something more realistic. Then maybe you might have more of a hit on the average price side. Benchmark is always good, but it is you're just comparing like what is the sort of typical property in each of those markets, and you have to have enough transactions of that type of property, and it gets revised. Like I had a call this week because they just did a large revision to the HPI, and they revised. I think they've revised most of the history of the series, so it changes prices, makes it look different sometimes. That can be hard to communicate with, like if you were sitting down with a client and you were talking about the HPI, and then they came out with a large revision and it's completely different. That's a tough one to explain, I think, when you're sitting with the client. So just for communication purposes, average is probably the best. All of them have weaknesses. I tend to concentrate on average prices just because it's more transparent. It's very transparent. It's easy to explain. Right.
Yeah. I don't know. I keep looking at it, and like I think sometimes average makes things look better, and sometimes it makes it look worse.
Tell me how. Hang on, Brendon. Tell me how bad I am at being an economist, because I've been doing this lately and just looking for the trend. So I've been taking in our what do we call it, Stat Center, our Fraser Valley board way we can check our stats. I've been taking average price and then doing a 12-month rolling to kind of see the trends. And basically since the end of 22, it's been a downhill slide. It hasn't done the like actual seasonal pricing swings that we've seen, and it's almost like a straight downward trend. And I feel like that's actually more of what the market has done, even though technically prices were higher at certain times. I do feel like it's been a continuous downward trend since obviously the end of 22.
Yeah, it's fine to just kind of smooth out the noise in the average price, right? Like that's, and I think that you're just looking at the trend in pricing, and like it's been very weak across the Fraser Valley since the jump, I think in 2025. Which is what you'd expect. Really, really slow sales and inventory that's a little bit higher than what we consider like healthy for the long term. There's probably 1,000 to 1,500 more listings in the Fraser Valley than what we would like to see long term, given if sales were back to normal, like what we would need to keep the market in balance. So it's an oversupplied market, and that's not even counting the new side of things. And sales are really weak. So prices should be coming down.
I also wanted to ask you about the way in which the reports come out every month, whether it's your board or here in Toronto. Is there's so much focus put on year-over-year numbers. And again, it's like every month the news story flips from sales were down 15% to sales were up 32%. And is it really important, the year over year? Like, I get if you bought a property a year ago, I get it's the same month, just different year. Is that as important as the trends over the last 3-4 months? Like, I've always thought what's happening now is more important than we can't go back in time. But there's so much focus put on those. Those are the numbers that are reported on the most.
Yeah, so we do that for sales just for seasonality purposes. Like you don't want to, like there's obviously seasonal patterns. Sales drop a lot in December and January, and then they jump in the spring. So if you're going to like month over month comparisons, don't really make sense,
Right.
just because there's all seasonality. You can seasonally adjust. There's obviously statistical methods that people use, but again, when you start to communicate, not everyone knows what seasonally adjusted data is or how it's done. So sometimes the easiest thing to do to communicate is year over year. For prices, there shouldn't be a lot of seasonality. So the year over year price comparisons maybe don't make as much sense. It makes more sense, I think. And we fall into this with all kinds of economic data. Like I was talking to someone the other day about retail sales, which look really strong in BC because they're still rising at like 6% year over year. But a lot of that's just like, we were kind of, still like a level kind of from things were rising over the past 12 months. So they've actually turned over since June, right? Mm-hmm. So yeah, it's still higher year over year, but down over the last 3 months. And we get some of that effects in housing as well. What we've been doing a lot lately is just comparing to a 10-year average, or a historical average. If you don't like the 10 years, last 10 years might not be super representative of how a market should be. But we kind of compare like, well, what does this look like compared to its average? And pretty much all year sales have been 20-25% below their 10-year average. So sometimes that's a better way to look at things. Like how close to normal is the market right now is, I think, a good benchmark.
It's going to be really interesting to see what, even if sales pick up slightly, like 10 to 15%, I get that 2021 year is still going to be in there throwing everything off, but the 10-year average not going to look too bad shortly because the last 4 years have been such low. Yeah. Like it's not going to take too long that being above the 10-year average becomes the norm again, because 5 of those 10 years were the lowest sales volume years we've seen in 25 years, right?
Yeah, the last 3 years have been some of the lowest years we've had. So yeah, it's once that's in the window of the 10-year kind of window, it's gonna make things look a little better, I guess.
So we are recording this.
Hang on, Tom. Steve, I want to just chime in on one thing. I wish we could figure this out, and I obviously don't think we can. But when the market is heated, there's a lot more reasons why everyone involved in the transaction would want to get the transaction to come together, right? Sellers want their money out. Buyers want to buy a property that's going up in value. Banks want to lend mortgages. Like everybody involved wants things to go. So I think now that stuff is tougher and there are people cracking down, there's an amount of either overt mortgage fraud that was happening and that is likely not. And that's something we can never adjust for. And then there's the not overt mortgage fraud. There's the like, is this going to rent for $2,600 a month when it goes, or $2,800 a month, right? And that's all, kind of subjective. So I think that is likely a much larger part of an overheated market, that when things are good, people are just jamming deals together as best they possibly can. And I would assume we're not going to get any sort of data on how flawed the information used to obtain mortgages was, but I'm betting that it's much tighter and stricter now because the times aren't so good and banks aren't so willing to just lend, because the problem isn't just going to fix itself with prices increasing. And I don't know if there's anything. I mean, obviously you're not going to get reports from the banks, I don't think, on how much mortgage fraud they've discovered, or if that would play into it at all. But I think it's something that the industry as a whole probably needs to address in some way.
I think if we were seeing a lot of mortgage fraud, it would come out, once the tide rolls out. You would find out who's swimming naked. What's the metaphor? Because you would get a lot of defaults, right? If people were like lying about their income or lying about their assets or lying about their ability to finance a mortgage, you would see, once things get weak and prices are coming down, once the economy is weaker, you would see a lot of more defaults. We've seen a bit of an uptick in mortgage arrears. It's one of my pet peeves is how it's reported in the media, because they report percent changes of a percent, which is
Yeah.
about the dumbest thing that you can do reporting stats. So it's like arrears are doubled and they're up from 10 basis points to 20 basis points.
Yeah.
So
Good headline.
Well, we
though.
are seeing it. We are
Yeah.
seeing it in our business, though. We are seeing.
Yeah.
I've dealt with more foreclosures this year than I have since probably about 2013. So, and I mean, I've always done usually one a year in the good times, and now we're up to 4 or 5. So it's a lot more than it was. I also have connections with the banks, of which I'm going to get those listings at a higher rate than most
Sure.
people. It's not like every realtor is carrying 5
Well,
foreclosures.
it's a long process, right? Foreclose, like you can stay in a house after you've missed mortgage payments for a while, I think, is what I've always heard.
Oh, we don't even get the file and usually get listed until they're 18 months in.
Yeah. Yeah. So it's kind of a lagging indicator, right?
Yeah, totally. So I don't know. I just think it's something that needs. I wish we could find it and address it, because I think, and again, some of it is, some of it was probably legitimately overt mortgage fraud. I don't think it's a ton, but then there is the, how are we going to finance this, or do we need to say that it has a kitchen downstairs when it doesn't have a kitchen downstairs? There's creative financing that has come into play. And I think a lot of that has been tough because, as you mentioned, the rental market's come down. I was actually, one of my rentals has gone vacant, and I'm doing my research right now on what I'm going to re-rent it for. And it's a lot less. It's a lot less than it was previously. It's actually such a low number where I'm maybe not going to rent it out anymore.
Oh, wow. Yeah.
Right?
Turnover rents are down 10% or more in like most big markets.
Mm-hmm. So I don't know. I think all that's, it's all converging. And then, as you mentioned, the Fraser Valley was the place to go, because if you were from Vancouver, you went and got a house in Surrey for half the price it was in Vancouver. So that's why we saw such a run up. I'm interested. Sorry, Tom, I didn't want to. I have another thought, but
go for it. Keep going.
I just wanted to kind of.
Brendon said yes to 3 hours this morning, right? Okay.
Oh, for sure. Yeah.
Yeah. Okay.
I just wanted to kind of change the opinion. So, or the opinion. Change the opinion. I wish I could do that.
That's why I host this show. All right, try again.
The topic to kind of forward looking. So we've covered where we were. We know that it's bad. We know that our predictions of being positive at this time last year were terrible, and the modeling worked perfectly, as it always does.
Always.
How wrong are we going to be about next year? I'm very interested to find out whatever we say here, so I can bet against it for next year.
This episode of the Tom Storey Show is brought to you by Karrasch Dunlop. Real estate agents, you spend months, if not years, earning your clients' trust. You don't want to lose it on inspection day. For over 45 years, top agents across Canada have relied on Karrasch Dunlop for home inspections that are clear, calm, and client first. Their inspections don't just find issues, they know how to explain them in a way that will protect your client and your credibility. If you haven't worked with Karrasch Dunlop yet, now is the time to find out why Canada's best trust Karrasch Dunlop for home inspections. You can learn more at carsondunlop.com. I will also tell you, in the Toronto real estate market, whenever I see a pre-home inspection by Karrasch Dunlop, I know my buyers can trust it. And Karrasch Dunlop is a company we've used so many times over the years for our buyers and sellers. carsondunlop.com. And now, back to the podcast.
I'm trying really hard to be optimistic, but there are a lot of headwinds. So I think like the recipe for a better 2026, I've been saying in presentations, is sort of 3 parts. One is like some definitive end to the uncertainty about tariffs, like a resolution. So we're not talking about tariff. Like my dream for 2026 is not to talk about tariffs in presentations. I probably, obviously I'm going to have to talk about it, but not nearly as much. So some resolution, and that could come from we renegotiate CUSMA in 2026 with the United States and Mexico, and comes out favorably. We don't have to deal with tariffs anymore. We're at a point where like the Supreme Court heard arguments about the legality of the one type of tariff that the United States has levied, these economic emergency tariffs. Betting markets seem to think that they're going to be deemed illegal when that decision comes out in June 2026. That takes away a pretty big, like a lot of leverage for the United States, because those are what type of tariff that the president thought, I guess, they could unilaterally levy without congressional approval, and they're kind of have no expiry date. Turns out it's contrary to what the Trump administration would say, those tariffs are a tax on Americans, and the president can't unilaterally levy a tax without congressional approval. So it's very likely that's going to get shot down. There's still other tariffs that they can reach for, but those tend to either need congressional approval or they have like specific cap, like 15%, and like a time limit of like 120 days before you have to go to Congress. So takes away leverage, which means during Kuzma, Trump just can't say, take this terrible deal, or I put a 50% tariff on all of your exports to the United States. So hopefully we get some definitive resolution there that would reduce uncertainty, reduce the risk of a recession, reduce the risk of job loss, hopefully bring some confidence back to the market. I think that's very likely. So that's the one. I think we can kind of check that one off. The second part of that recipe was the economy picking up, and that's a lot less likely. I think we're going to have a third straight year in BC of under 2% growth. I was just at the Economic Forecast Council. I think the consensus forecast was like 1.3% GDP growth for 2026. That would be 3 straight years of GDP growth with a 1 handle, which is just stagnant. Not a recession, but very, very slow. There's a lot of headwinds there too. If you look at like mortgage renewals, there's still about 30% of mortgages coming out for renewals in 2026. 13% of outstanding mortgages are going to see a payment shock of 20%. Those are mostly 5-year fixed, people with a 5-year fixed mortgage or more. That could cut into spending, so we can see household spending slow down a little bit. Our government is running a pretty significant budget deficit that they need to get a handle on, which could mean some real cuts when the budget comes out in February, if they're at all serious about getting their budget in order. There's a lot of political pressure for them to do so. Everyone, no one is, especially in the business community, is happy with the state of government finances in BC, but people who work for the government buy houses too. They buy cars too. So that'll be a hit to the economy if we see any kind of like real cuts in payrolls or spending by the government. So that's kind of a headwind. And then just population growth. So we're still trying to engineer the first decline in Canadian population since Confederation through our federal immigration policy. And that just is a natural slowing effect in the economy. There's less people around to spend money and less people, to be employed and working, which means our like hours worked in the economy, which is growth in hours worked this year is negative. You can think of GDP growth as growth in hours worked plus productivity growth. And our productivity growth is very bad. So if we're going to have negative hours worked, it really shines a spotlight on productivity growth to like shoulder our ability for the economy to grow, and it doesn't change overnight. So really challenging year ahead. So I don't think we're going to get a pickup in the economy in 2026. Hopefully things get back to normal 2027. And then rates. Rates are the third piece of the puzzle. I don't see the Bank of Canada lowering rates again. Markets are currently pricing in a rate hike at the end of 2026. Bond yields have jumped a lot in the past. In one day after GDP came out, they jumped 20 basis points essentially, which is a huge move for daily.
Can you explain that to us for the people that don't understand anything of why
Not
bond
for
yields
Steve,
move
though.
like that?
Steve gets it. For everyone else,
I need it at
a 5-year bond yield, or why it moved.
Why it moved the way it moved on a 5th grader explanation level for myself.
Yeah, I mean, easy answer. I don't know. Like we got GDP data. We got GDP data that had a really big headline, right? Like the Bank of Canada's forecast was for 0.5% growth in the third quarter, and it came in at 2.6. But the underlying data was really bad. So that 2.6 was driven by 2 things. One, a one-time purchase of weapon systems by the government as part of its commitment to increase military spending as a share of GDP. That's not going to happen again in the fourth quarter. And we didn't really have good data on trade because the U.S. government was shut down, and we rely on them obviously for a lot of our data about how much stuff we're selling to the United States. We didn't have clear data, so there's going to be a big revision to the third quarter. It might end up being weaker than the headline, but even that headline number 2.6 was a bit misleading. If you just stripped out government spending and trade and looked at just business investment and household consumption, what's called private sector, final sales to the private sector demand essentially was negative, which means businesses and households were spending less in the third quarter they were the previous quarter. So underlying fundamentals are really weak still. And yet markets interpreted that really strong growth as, well, the Bank of Canada's not only they're not going to be cutting over the next year, they might have to raise rates. And that gets priced into expectations of higher rates, going to propagate through the yield curve, and the 5-year bond yield jump. I looked to see if there was anything similar. Like the United States, sometimes we'll get big moves in our bond yields when we have like someone from the Fed comes out and is more hawkish than the markets expected, and yields jump on something like that. That didn't happen that day. Fed's going to cut today, so we'll see what their statement. If they have an unusually hawkish statement along with the cut, then maybe we'll get some more upward pressure on bond yields because they're kind of globally determined. But most of it just seems to be in investors, really shifting their expectations about the course of monetary policy in Canada over the next year.
I've got good news for population growth, though. Steve's got a plan for our country. And it's to get kids to stop gaming, get out there, drink more alcohol, make bad decisions, and we have more babies. Just so you know, we've already got it figured out. It's okay. We'll be fine.
Okay. Yeah. Well, it's funny when you look at like the people get weirdly obsessed, I think, with like fertility rates, especially people who have podcasts. But like mostly like tech people are weirdly obsessed with it. If you look at fertility rate, people are actually having the same number of kids. They're just waiting longer. So if you actually look at like cohorts, I saw a really great, I think it was a blog post on this week. The like expectation, like the amount of kids that people have is still like on average 1.86 or something. They just have them later. It's the biggest reduction in the fertility rate has been like, maybe Steve is with the alcohol and stop gaming. It's like, we don't have teen pregnancies anymore, right? Like we figured out as a society that teen pregnancy is kind of damaging, and we don't have, and maybe video games have cut down on teen pregnancy. I don't know, but we just don't have the same rate of teen pregnancy that we had in like the 80s and 90s. Like in my graduating class, I think we had like 5 girls that were pregnant. Like it was pretty normal. So I don't know, maybe that was a Chilliwack thing, but that doesn't seem to be the case. That doesn't seem to be the case anymore, right? So, and that's good. Like it's a positive thing. Like it's pretty disruptive to your life to have a baby in your teen years. So that's a big part of the current drop in fertility is we just don't have teen pregnancies at the same rate.
I wonder what we could do to our GDP if we subsidized alcohol in nightclubs. No, never mind. Bad idea.
100. I don't. Drinks are expensive, so how much would it have to be for like $200 a month? I don't know.
I think we've gone off the rails.
Let me kind of bring this back here. We've talked about, you've used the word confidence. I haven't had a counter on the screen, but I think 4 or 5 times at this point.
Really?
I saw a chart recently that showed that in March of 2025, the general consumer confidence of Canadians was lower than during the beginning of the pandemic and lower than in the 2008 with everything going on with the financial crisis in the States. Let alone if we think it should have been lower based on tariffs and trade talk and Trump. It was. It froze people. Can you explain kind of why maybe that happened? Because I would think a global pandemic maybe is a little scarier than trade talk, but apparently not for confidence levels across Canada.
Yeah, it's interesting when you look at any matter, like there's like the uncertainty index. I think that everyone has seen those charts this year. It also showed that uncertainty was higher during the sort of tariff hysteria than COVID and the financial crisis. Some of those measures are like, you can quibble with how because they're really just scraping like mentions in media, and maybe that's not like the best measure of uncertainty. But you're right, like consumer confidence measures were low. Business confidence measures like the CFIB, I think Business Barometer Index was at its lowest level ever. So, good like, soft data kind of evidence that like, yeah, everyone households, businesses were freaking out at the same time. Why it was so much worse is maybe because it's much more structural than anything else. Although if you put a 25% tariff on everything that Canadians are going to sell into the United States, and it's going to be there permanently, you're structurally changing the composition of business in Canada for the long term. Maybe that's what it was. Whereas some of the COVID, first few months were like obviously terribly frightening, but I think people had an idea it was going to end right at some point. Financial crisis is a little different because there were some comparisons to the Great Depression and stuff at the time, but I don't know why this would be an event that would hit business confidence so much harder. Maybe it's social media. Maybe it's just like you're just in your face so much more now than 2008. I don't know. It's a tough.
I think that's probably what it is, right? There's just more information now everywhere.
You can just doom scroll how bad things are, and the algorithms feeding you nonstop. Nightmare stories about how bad things are going to be. Maybe that's it.
I can hear the comments already saying, which is just going to be the political divide, which will say Trump had nothing to do with this. This is Canada's productivity problem, and they're going to go, that's all of the commenters, and they're going to say, because honestly, both things can be true at the same time. If you like our government and you voted for our current government, you're saying that Trump is the problem, and it definitely was. I had a ton of clients that were like, I'm not moving, uncertainty, all this stuff. It was funny because they all have pensions and paid off houses, but that's another story. And then you have the other side where they don't like our government, and then they blame our government for all of our lack of productivity and the poor economy. I'm going to say both of those things are true at the same time, and picking sides on one of those things is stupid.
They can both be true. Right. And one is cyclical and one is structural. Like we've had a structural productivity problem for a long time through all kinds of governments. But that doesn't make the cyclical part any less true. It just compounds it. Right. I will take a bit of a victory lap, though. I remember a commenter, because I read the comments against all this.
Your first mistake.
But last year when I was talking about tariffs and how the Trump administration didn't understand tariffs, I think there was a comment about how I can't believe you think that Trump and Scott Bessent and all these people don't understand tariffs. And like, it's been pretty clear at this point, they don't understand how tariffs work or are willing to lie about how they work. So just a victory lap. About not reading comments. Once when I was in grad school, I got my comments back as a TA, and you get TA evaluations at the end of the semester. And they were very negative about me. I think one was just all caps in pencil. Right? Doesn't know anything! Like 5 exclamation marks. One just said "big head," which I don't know if it meant that my head physically is large, which is not unusually large, or that I was really arrogant, which me at 20, 22 is probably pretty accurate. I was a very bad TA, but I was at a economics graduate department party at the grad chair's house at the keg, and I was complaining to one of my fellow grad students about how bad my TA evaluation was, and the grad chair turned around and said to me, "Why are you reading your TA evaluations?" Right? So yeah, that was like don't read the comments. Don't read the comments. From
don't read the real comments in real life.
Do the students put their name under it, or is that anonymous too?
No, they're anonymous. I ranked, but I ranked, I think at that semester 39 out of 42 in TA. So there were 3 that were worse than me.
Well, look at you now, chief economist. Right? Yeah, there you go.
Brendon, with your crystal ball's probably, is it to your left or to your right now? So your crystal ball, if you had to get it out and make our projections for where we're going to be 12 months from now. And I'm assuming we're talking probably, let's talk prices within the lower mainland of BC, because that's going to be the majority of your focus, I would assume. Where are we projected to be?
12 months from now. So I think the lower mainland is going to, it's because like you have to really separate into two markets. Outside the lower mainland, I would expect it's going to be a much more normal looking year with some little bit upper pressure on prices and sales that are getting back to, like, they're already around the 10-year average. If you look at everything outside of Metro Vancouver, Metro Vancouver's got some other issues. I mean, sales are so weak. It's going to take a while for them to get back to average levels. And there's no real stimulus that's going to happen. Like, there's no, like, some upper pressure on rates happening. There's nothing besides just pure, like, mean reversion, right? That would be driving sales higher. Like, we've had sales that have been so slow for so long. There's all this pent up demand. Eventually you'd think it's going to make its way into the market. So that's sort of the main driver, but that can take a while. There's no other, like, obvious impetus, like, why sales would really pick up. So in the lower mainland, we're going to have probably slow sales for, most of 2026 with inventory that's a little bit above what we consider like balanced. So I wouldn't be surprised if we saw some downward pressure on prices in Metro Vancouver and a little bit upward pressure on prices elsewhere. So, lower mainland's like 40% of sales or something. So it's going to, I imagine we're going to have prices that are either kind of flat to down slightly in 2026.
Hey, podcast listener, if you're looking to buy or sell a property in Surrey or the Fraser Valley, you have to reach out to Steve Karrasch, my co-host. As much as we make fun of each other on this show, the truth is that I do this podcast with him because he is reliable. He has an opinion. He knows what he's doing. He has a ton of experience. And although I have never personally sold a home with Steve, if I were and I was in that area, he would be my number one choice. And let's be honest with each other. As much as he has a hard exterior on the show, he's a little bit of a softie once you get digging a little bit deeper. So you can reach out to Steve in the link in the description. I hope you enjoy the rest of the podcast. I got a question about Bank of Canada. We're recording this on the morning. It's coming out a few days later, but we're recording this the morning that they held rates in December. So we've stuck at 2.25. I think everyone expected them to do that. You mentioned you woke up early this morning to make sure to see the announcement. I look at this and this is just my real estate agent viewpoint of this. I think this is great that they've come out and said that we're done for now. Yes, there might be a 25-point hike at some point next year. That could happen. Lots of unforeseen things could happen. But if we're going back to sales volume, I think, okay, they stopped going down. The general consensus is like holding pattern here for a while, right? Maybe tell me if I'm wrong, but I see it where there was a lot of buyers that were watching prices slowly dip down. The listings that they had favorited were changing prices or coming off the market. And they're like, well, why don't I just wait to see if Bank of Canada goes down once more? I think them holding is a good thing. But then on the flip side, I think this might actually be more important in the actual sales volume side. You know who was more obsessed with Bank of Canada rates going down? It wasn't buyers, it was sellers. Every seller would go, well, I don't want to decrease my price yet. Even if I take it off in December, let's put it back because they might decrease the rates again, and that will bring back activity. But every buyer was waiting for the same thing. Now that we've had no certainty in the market in 2025, none at all. Let alone like the tariff cloud over us. But then like what Bank of Canada is going to do, and still I think probably 75% of people are taking fixed rates anyways. But it's a talking point. It comes up in the news like all these other things. Do you think that alone, certainty of the overnight rate remaining where it is for 6 months or more, could on its own help sales volume? Because I think for sellers, if they're like, okay, they're done, well, then this is what's available to you now in today's market at this price point, or get off the market or sit there and let the listing expire. Is there anything behind my theory here? Or am I completely off?
No, I think there's like a market psychology thing, but some of it's rooted in like a misunderstanding of how interest rates work. Unfortunately, when the Bank of Canada cut rates in October, the 5-year bond yield actually went up because their statement was so hawkish. So you can have, a hold or a cut where it's actually bad for 5-year fixed rates, right? So like where you're actually not better off waiting because now market expectations have changed and maybe the 5-year fixed rate's going up from wherever it's at right now, 4.5 for most lenders to 4.7 or something, right? So you actually made yourself worse off by waiting. But that would be like if we had, rational expectations and everyone understood exactly how bond markets are linked to expectations and the overnight rate. I think most of the cases, it's just like what you're saying. Most people's understanding of monetary policy and rate markets is Bank of Canada controls interest rates. If the Bank of Canada is holding rates, then rates are going to be steady, which might not be true.
Right.
But if they think it, then it can drive behavior.
Because most Canadians sell a house how often? Like once every 7 to 10 years, maybe. They rely on the information they get from the headlines or their real estate agent. They're not in this world. They're not really tracking it. They see the headlines. They go, oh, they're done bringing down rates. Okay, I guess that's the environment we're in today. That alone, I think, somehow will make a little bit of a difference, at least.
That's a really good point. Like the thing that we live in this every day, and for most people, it's a once or twice in a lifetime thing. Like even caring about mortgage rates is like such a rare thing for most people. It's no surprise they're not like that tuned in to how everything functions. But like it's a rare event to buy or sell a home.
The mortgage renewals that are coming up in 2026 and 2027. I know you mentioned that like a certain percentage of them were going to be over a 20% payment. Do you believe that brings more listings to the market, that's going to impact in a meaningful way what prices could be next year or the year after?
I have such a good chart for this that I wish this was more of a visual meeting.
If you send it to us, we can put it in right now.
Yeah. So for BC, we did some work to look at which areas would be most vulnerable to renewal risk. Just looking at like where is affordability particularly poor, and what markets have the highest share of owners with a mortgage. This is unfortunately another example of where the Fraser Valley kind of takes it on the chin a little bit. It's in the worst quadrant of most of the large markets. So we have like these 4 quadrants. With all these bubbles by market size. So like Surrey, I think 68% of owners in Surrey have a mortgage versus like 50% in the city of Vancouver. So very, very different. Squamish is like, which is kind of, in between Vancouver and Whistler. It's like 70%. And then like a market like Parksville, which is like a retirement community on Vancouver Island, 39% of owner households have a mortgage, right? So like the extreme ends. Most markets in the Fraser Valley have fairly poor affordability in terms of mortgage payment, like benchmark kind of mortgage payment to income, and a lot of people with mortgages. So those are markets where you might see more vulnerability to renewals, where you might see, might be maybe more likely to see listings tick up if people can't afford their new mortgage payment. Other like City of Vancouver, Richmond, Burnaby, like the big suburbs around Vancouver, have very poor affordability, but they also have fewer households with mortgages, so the risk isn't maybe as high. It's something to monitor. Like we're not, we already weathered about 30% of mortgages, Canadian outstanding mortgages, already renewed in 2025 without a whole lot of disruption in terms of mortgage defaults, or new listings were a little bit elevated, but not huge spikes. So we've already weathered a pretty significant chunk of those renewals without a lot of disruption. I don't think we're going to have a ton of disruption in 2026 either. But it's certainly one of those like risks that we're closely monitoring.
Do you know the size of the mortgages in these different areas? Because like a 20% change on a $200,000 mortgage is way different than $1 million mortgage, right?
That would be cool data to have. We only have aggregates about like the share of mortgages that are like, or the share of mortgages like that are more than I think 4.5 times income or something. That from the Bank of Canada. Banks have that data. The Bank of Canada has that data, but we don't have like anything split out to that level of detail. That would be phenomenal if we did, because then we could really get more granular. But I think what we have now is like a pretty good overview of like where the risks are, but maybe not like how elevated maybe in each market it might be.
I'm going to ask you another question you might not have the answer to, but I'm just curious. Like, you're the guy that would know this. So like the percentage of overall mortgages that are going to renew this year is very, very high. Do we know how many of them actually purchased at the peak of the market as well, versus it was just a renewal that they took 5 years previously, where it's like the people that get both bad ends of it is not only is your house down 20%, but now your payment's going up. And on the new mortgage, even though you were aggressively paying down the principal on the first one because the rate was 2%, just based on how the math works, not only is your house down, your payment's up 20%, and your new payment is actually mostly it's 60% of it's going to interest now instead of the flip on the other side. So do we know that?
I don't know that we do. There's a really good Bank of Canada paper about this, so that they might have that data. I don't remember seeing it, but now I'm going to check after this call, because that'd be really, really good to know.
And then I want to just say one thing, because silver lining here. What about the renewal relief that's coming if you took a 3-year rate in October of 2023 when rates were at 6 point something percent? It's going to be the opposite. You're going to go down. You're going to be happy. And then, I don't know how many people take 4, but 3-year and 5-year, and then 2 more years, you're going to get people going from 6% back to wherever we are, hopefully lower than that.
Yeah. From that Bank of Canada paper, if you have a fixed rate under 5 years, your rate in 2026 will reset at a 3.2% lower payment.
Okay, so that's interesting.
Yeah,
okay.
Yeah. But if you have a variable rate with a variable payment, it resets at 7% lower.
Oh yeah, I mean the variable people have already gone through the ringer. They've been
what a nightmare ride they've had.
Right, I'm one of them.
Where do you? So we're expected Bank of Canada is going to hold now for a year and maybe increase eventually. What's the rumors of which way the Fed is going? They're going down currently still. Where do we think they will stop? And then, I mean, I assume the plan will be to get rid of Jerome Powell and put in somebody who will bring them all the way down to zero for Trump, because that's where he wants them. But where's the projection for U.S. rates?
So even with the Bank of Canada, like they think that neutral for the economy is between 2.25 and 3.25. So that's why like 2.75 is like generally the long-term destination, which if they need to raise rates, it's really just about getting back to like that midpoint. And that's why, like, if things are better than expected over the next year, we don't have a big tariff shock. That's why they might raise rates. In the U.S., their neutral rate's more like 3, and they're still like, what are they at now? 4, between 3.75 and 4. Is that right? Is that if they cut today?
I think.
So they would,
but the consumer rate's still over. Like the rate people get ends up being like 6 still. It's still over 6 for most Americans.
Yeah, like their mortgage rates are.
Yeah, the actual mortgage rate.
30-year mortgage rate. Yeah. Yeah, their system's totally different. Like there's so much more refinancing. And what was the original question? Oh yeah, where rates might go. So where they should go, like, so they have a bit of a different problem than us in that their economy is still growing at a pretty decent clip. Most of it is just huge investment in AI, like software and data centers and that kind of thing. Really carrying most of the burden of growth in that economy. I think it's I think it accounted for like 2/3 of growth. I think in most. Although we don't have Q3 GDP because of the shutdown, but a lot of their economy is just being driven by AI capex spending, and inflation is still like around 3%. So there's not as much reason for them to cut rates as perhaps there would be in Canada, and really like there's only upward pressure on inflation right now. Not really the environment where you would normally be cutting rates, right? Like, if you look at, there's been a pretty significant reversal, especially in goods prices, once tariffs were introduced. That's going to be, we've had businesses, taking, eating the tariff a little bit, and not fully passing prices through for the last few months because kind of waiting out to see if these tariffs are going to stay. But eventually those will be passed through to prices fully. You get an upward pressure on inflation. So that's not normally an environment where you'd be cutting rates. Is an economy, with still very low unemployment and inflation that's well above target. But there's a lot of political pressure for them to cut, and you can make an argument that rates don't need to be so above neutral. Like if neutral's 3, like do we really need rates way above neutral? Do we need to be stepping on the brakes as hard as they're trying? And then you have all the political pressure. Powell was replaced is it mid 2026, early 2026?
Somewhere in there.
Yeah, and it really depends on who his successor is. The current candidates go from like totally unserious apparatchiks like Kevin Hassett to more serious people like Kevin Waller that are currently on the FOMC. It seems like Hassett has been the choice because he's the most malleable. He's also the most insufferable. If you ever watch him, he looks like. Do you guys watch What We Do in the Shadows? He looks like Colin Robinson, the energy vampire. Anyway, look that one up. His doppelganger in all senses. Anyway, markets do not like the idea of Kevin Hassett because they think he will just do what Trump tells him. Lower rates too much and drive inflation higher, which drives interest rates higher on the long end of the yield curve, makes mortgages more expensive, all that. So hopefully, the news this week has been like, oh, maybe Hassett's not the number one choice, because I think what market's been telling the administration is this is a really bad idea. And maybe we'll get a more serious candidate, but this is not a serious administration. So I would vote for it's going to be a total clown show, and they'll put in the most underqualified person possible who will do whatever.
That sounds about right. I even saw, what was it? There's a bunch of companies, including Costco, that are suing to get the tariffs back.
Yeah.
Right. Like they're like, okay, as soon as this thing goes through the Supreme Court and we find out it's illegal, we want all our money back.
They're owed their money back. All American businesses, and really hard for the administration to keep claiming that foreign countries pay the tariff when you're cutting checks to American businesses, right?
Did you ever watch Succession?
Oh, of course.
That final season when he looks at the kids, he goes, "You are not serious people."
Yeah, I had that. That was one of the gifts that I used in my presentation at the end of last year.
I got one final.
Right.
Yeah, I got one final question before we wrap up today. The job numbers confuse me because they come out one month and they're like, whoa, we beat expectations. And then the next month they're like, whoa, they sucked. And then they're really good again. And if you actually look into them, it's mostly the differences is part-time employment going down or going up.
Yeah.
How much obviously jobs are extremely important for our economy. How much do you look into those? Because it seems like it's going up and down every single month, and and the projections are always wildly wrong in both directions.
It's noisy. So like in Canada, we lost over 100,000 jobs during the summer, which is why the Bank of Canada started cutting rates again. We had similarly weak labor market in the United States, which is why the Fed started cutting. And then all of a sudden we had 3 months of like really strong job growth. BC, not so much. BC's been weak for like we've had job losses 3 of the last 4 months. I just look at hours worked because it just tells you, not just are there more people working, but are they working more hours? They have hours cut.
Right.
You could have a job like my son works at a big box store, and they're struggling, so he's not working as many hours, right? So he's employed, but he's not working as many hours. So looking at hours worked is a really good signal of the strength of the labor market. The unemployment rate's still pretty elevated. So even though we've had stronger job growth, I wouldn't say that the labor market is strong currently. And some of that's been part-time work as well. So another really good thing to look at is the prime age employment ratio. So like what age, what share of the people aged 25 to 54 are employed? It's been pretty steady over the last few months. I think it's at least back to its pre-pandemic levels, but there was a while there where that was pretty weak too. So like it's interesting if you look at those trends in employment rates by age. Prime age employment has been pretty good. Youth employment is really weak, and then if you look at people over 55, they just like left the workforce in the pandemic and never came back. So like that rate has never returned. So the overall like employment rate might be a bit lower, but we're still doing an okay job of like employing like the bulk of the workforce, which is people 25 to 54.
I do have one more question. I apologize. We're going to go slightly over. Back to work, which I think should be rephrased as bank to work, because I feel like the banks are the ones really pushing on it here. Is that gonna, like, I actually have a buyer right now that works for the federal government that's like waiting to hear if he has to go back to work on the federal side, and then he'll buy a condo. If not, he's not going to do it. So that's one example of one more transaction. if on every level of banks and government, they're like 3-4 days a week, that alone could pick up sales volume slightly, no?
Yeah, I guess it's a distribution, right? From outer, areas to
Good point.
Business centers, or so. Maybe in aggregate it doesn't mean anything, but maybe it shifts some activity towards Toronto, Vancouver, Victoria.
Can make
Ottawa.
Fraser Valley even a little bit worse off on your charts.
Yeah, well, like it's one of those things. Like Fraser Valley has 28. Those markets, Fraser Valley, Surrey in particular, has like 20, and maybe Langley, 28% of the population, only 21% of the jobs. So like people still commute. Like we just, it's going to maybe change over the next decade, where hopefully we start to get, we have a med school going into SFU. There's a UBC campus coming to Surrey, the Surrey campus. Maybe that'll like jumpstart some more like offices being constructed in Surrey and that kind of thing. But right now it's still like a commuter suburb, even though it's going to be larger than Vancouver perhaps in the next 3-4 years.
This was great. I always really enjoy having you on the show and allowing us to just pepper you with our questions, because we want a real answer of someone that so I've said this before to you, but I really like, so many people like to play economists on the internet. Me and Steve try to have our opinions, but stay in our lane. I love to have someone that's really doing this, understands it. I don't care what your TA remarks were. I think you're darn good at your job. We appreciate you being back here.
I've gotten more likable, I think, over the last 20 years. I could see myself at 22 and be like, man, this guy sucks.
Well, thank you for coming back on the show. Thank you, everybody, for watching and listening, and we will see you next week. Bye.
And subscribe.